Hello, welcome to the Credit Compass, helping you navigate the world of European credit, where we delve into topics shaping the economic landscape of Europe and the UK. My name is Gordon Kerr, European macro strategist and your host. Today, we're diving into three major developments: Europe's increased defense and infrastructure spending, the real impact of tariffs and counter-tariffs on European trade, and recent debt restructurings likely to increase default statistics for the year ahead. Each of these has significant implications for investors, businesses, and policymakers alike. So let's get started. Over the past 2 years, European nations have ramped up their defense budgets in response to geopolitical instability, particularly following Russia's invasion of Ukraine. The NATO benchmark for defense spending, 2% of GDP, was long ignored by many European countries, but that's changing. On Tuesday, the 4th of March, Ursula von der Leyen, the head of the European Commission, roughly outlined a package of 800 billion in defense financing, including 150 billion announced as lending to countries to increase their own defense spending. The intention is to help pool demand and reduce fragmentation. The focus will be on air and missile defense, as well as drone and cyber defenses. The details of the proposal will be discussed at an upcoming meeting on Thursday, the 6th of March. Separately, the recent German election resulted in ongoing coalition talks, and amongst the topics being discussed heavily is an easing of the debt brake and an increase in defense and infrastructure spending by the country. Further, the UK has recently committed to increase its spending on defense and its support for the Ukraine. Why does this matter? Well, first, from an economic perspective, increased defense spending means higher government expenditures, which can help to stimulate industrial production, particularly in the defense sector. Companies like Rheinmetall, Thales, and BAE Systems are seeing increased contracts and order backlogs, and their equity prices have been increasing as a result. However, these investments often come at the expense of social spending, increased taxes, and lead to increased government borrowing, raising concerns about fiscal sustainability. However, it does help to solve, at least in part, some of the European growth problems. On Thursday, the ECB is expected to cut interest rates again as inflation continues to return to target. Even if the latest inflation number of 2.4% was a slight upward surprise to market expectations of 2.3%, the general trend continues to be towards target. So, with a growth stimulus from increased government spending on defense, albeit delayed, we also face a contrasting, more immediate impact on activity with a looming increase in tariffs. On Tuesday, the delayed tariffs for Canada, Mexico, and China came into effect, with reciprocal actions from both China and Canada. And Mexico is planned over the weekend. While this does challenge those markets, impacting their growth and foreign exchange rates, and potentially increasing inflation temporarily, from a European perspective, it puts some weight behind the threats that have already been made about an imposition of tariffs on European goods. Tariffs have long been a political tool used to protect domestic industries, but they often trigger countermeasures that end up with a result that hurts both sides. They tend to disrupt supply chains, increase consumer costs, and reduce business confidence. Recently, the US and European Union have clashed over the prospective tariffs on steel, aluminum, and the auto industry. The EU is preparing potential countermeasures to the ones suggested by the US, if or once they are, as hinted by the actions on Canada, Mexico, and China, eventually are placed upon European products. For Europe, the large automakers like BMW and Volkswagen have significant US market exposure alongside pharmaceutical companies. Meanwhile, American agricultural and energy exports to Europe are also under consideration and scope. Historical studies show that tariffs often don't achieve their intended economic protections. Rather, they create inefficiencies and reduce competitiveness. The big question now is whether upcoming trade negotiations will de-escalate tensions or lead to a prolonged trade war. The outcome will shape the investment climate and global supply chains for years to come. Lastly, I want to bring up two recent restructuring events in Europe that have come through recently. The first is not a full restructuring, just a temporary reprieve, but the final restructuring is still expected within the first half. Both of these firms' restructurings will take the default levels for European high-yield and leveraged loans up to levels not seen since the financial crisis, given the size of their outstanding debt. The first is Thames Water, a UK-based water utility provider that had a highly leveraged structure which eventually tipped over. It has been in a court-run administration process for over a year now, and the restructuring plan is still progressing with the sale of the firm to new owners being negotiated. We still do not know the eventual haircut that bondholders will take in the deal, but the latest news was an approval for the firm to take on an additional $3 billion in super senior debt ahead of both Class A and Class B bondholders, who hold a combined close to 20 billion sterling of debt outstanding. The newly approved debt prevents a government special administration regime and continues the bidding process for the firm, which has produced options worth $4 billion in potential new equity. The process will not be complete until later in the first half, and the scale of any debt write-down will be contentious. The second recent restructuring is of a firm that is widely held across the high-yield and leveraged loan market. Many CLOs hold debt from the European telecoms firm Altice. It is in fact one of the largest holdings across the entire market. With a highly leveraged balance sheet and rising borrowing costs, Altice has been forced to take aggressive steps to stabilize its financial position. The company, founded by telecom tycoon Patrick Drahi, expanded rapidly through leveraged acquisitions, accumulating a substantial debt load. However, as interest rates rose and revenue growth slowed, Altice faced mounting financial pressure. In response, it initiated a series of debt restructuring moves and actively pursued negotiations with creditors. The final conclusion of a restructuring of $24.1 billion of existing debt resulted in a haircutting of its net debt position down to $15.5 billion. Eliminating $8.6 billion of term debt. Secured creditors receive a 77% swap of their debt with a 31% equity stake, while the subordinated debt holders will receive 20 cents of new debt and an equity stake of 14%. Depending upon who held what, this could be a relief for some CLO managers given the extensive prevalence of the debt held within the portfolios. But those managers will need to make up for the losses faced. Although most will have held secured bonds, the new structure at only 4 times net leverage, and with rates coming down, should hopefully provide some reprieve and certainty to help the firm going forward. Nonetheless, both cases highlight a debt restructuring overhang that has come to a conclusion in 2025, but we'll see an increase in default statistics for the year. As you have heard today, Europe's defense spending spree will reshape industries and fiscal priorities, while ongoing trade tensions with the US continue to create uncertainty for business. But to take the positive, it has sparked Europe into action. Meanwhile, debt restructurings highlight the challenges facing heavily leveraged companies in a rising rate environment, but also bring to a conclusion the 2 largest and most widely held European restructurings. And as interest rates ease, the pressure on many leveraged firms should be falling away. We should hopefully be waving aside a difficult period for levered companies, albeit with a still challenging growth environment. Now let's see what the impact of tariffs may bring. For investors and business leaders, these developments highlight the importance of preparedness and adapting to shifting macroeconomic forces. That's all for today. Thanks for tuning in to the Credit Compass. Be sure to subscribe for more insights, and we'll speak to you again soon. As always, staying informed is key to navigating these complexities. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.